Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter. 8 years and running, celebrating 30 years, serving North Central Florida proactive savers and investors, formulating the plans to help you achieve your goals and uncomplicating the financial investment and retirement world. They are the team from GulfCoast Financial Services, founder and CEO John Kuykendall, here with us, as always, providing the information. And John, it is that time of year where we tackle everyone's favorite topic, taxes. And I guess here's the thing about taxes is even you have to pay them.
Well, that's true. And, when you get into retirement or when you get old and you're on Medicare and Social Security, you find out how important the taxes really are and how much income. And you wish you'd have done things a lot different, Peter. I mean, I've often told my son that getting old isn't for wimps. And I just got my IRMA letter the other day from Social Security, and I'm not happy that I'm paying so much for my Part B Medicare.
Well, it was in no way an age-based wisecrack, John, but since you bring it up, there is nothing that is written in stone nor in the tax code that says that retirees or those of a certain age pay less in taxes. Now, that's the paradigm that a lot of us have saved under, the premise that we'll be paying less tax later on down the road. But we're actually seeing a lot of people rather surprised by the amount of taxes that are due on that grown and invested nest egg.
Well, that's the problem. I mean, I think we were taught when we got into this 401k thing in the 80s, we were taught to defer because we were going to be in a lower tax bracket. The thinking is that we were going to have less income. The problem is that most of my clients don't have less income, and it's putting them in a precarious situation because they have to pay more in taxes now.
And in addition, John, those tax rates that we're under today could change at any point in the future. A lot of people are concerned about them going up.
Well, that's right, Peter. We've forgotten that the current tax situation sunsets in 2025 and starting in 2026. Which is 4 years from now, really, we will be under a new tax code. Now, based upon all the money that we've given out during 2020 and the COVID era, and now with Secure Act 2.0 and all of the stuff that we're doing to keep the government going, there's no way you can tell me that taxes are going to be lower when we get out of this current tax code. So it behooves us now, even though taxes are a tremendous burden for a lot of our retirees, it behooves us to start doing some serious tax planning because we're going to be sitting in a different situation very shortly. I mean, that comes up before we know it, Peter. And why is it that people put off planning about taxes? When you're working, taxes aren't really that big a concern because I'm earning income. But in retirement, I'm living off my investments and the income that I've generated through pensions and annuities. And I don't have a way to make any more or to make it up, and my deductions are less. So, a lot of people right now aren't filing taxes because we got that huge standard deduction, but that's going to go away. And so we don't know whether they're going to keep that or lower it back to where it was, and taxes could even be more horrendous than they are now.
So an old saying, when opportunity knocks, right? Answer the door. John, are you saying that right now might be one of those critical opportunities to pay taxes while they are on sale? If we've got a large tax deferred balance, we should be paying particular attention to what we can do today?
That's right, Peter. And there are some things I know that if you're 65 and you're on Medicare and Social Security, we have to be careful about how much we take out of our deferred accounts. But if you're based on your income, there may be a way that we can still do a partial Roth conversion move that money from a tax deferred into a tax free and still not pay any more in taxes. And so it helps us to be able to do that. We need to sit down and think about that. Opportunities knocking. And if we don't take advantage of this, I think we're going to be really hurting. Medicare is running out of money. Social Security is running out of having enough to fund 100 cents on the dollar. All these problems, plus more taxes, are staring us in the face. It's time to sit down and do some serious tax planning.
Well, John, I know that news here recently has included the discussions of the debt ceiling limit and reaching that and renegotiating that and extending it further. So that prompted me to check out usdebtclock.org. And at the top, it's got the high level advertised debt, mere $31.5 trillion. But if you look down the page, it talks about the unfunded liabilities, including Social Security, Medicare, and Medicaid at $110 trillion. So all that being considered, do you have a lot of clients worried that taxes could go up even further than the increase already in place?
Well, the problem is you're looking at almost $150 trillion in liability. And that's going to get even worse as we continue to raise rates because we're paying more interest on that debt. So, now I think everyone, if there's anyone not concerned about higher taxes, I don't know why they wouldn't be. In Florida, we're concerned about real estate taxes, our homeowners insurance, which is quadrupling almost daily. It's crazy. People are getting canceled. My insurance went up 40% in 1 year. And I'm not near water. So, go figure that. But taxes are certainly one of the main things that we should be concerned about.
Well, I know that as you are formulating that financially focused written retirement income plan, a large portion of that, John, is how to create the most efficient, advantageous system for distributions of income and even the eventual passing of legacy. So you are looking for and trying to proactively identify opportunities to be more tax efficient as part of that planning, a look forward approach rather than a look back at last year and prepare the documents approach. That is a difference, a distinction in the results that we are going to get at the end of it all with how much of our money we get to keep, that proactive forward-looking approach.
That's right. Income planning with tax planning is very important. I don't think you can do anything that's more important than figuring out how much income you're going to need in retirement, and then the proper way to get it, the distribution from my assets, restructuring my assets so that I get the most tax advantage out of them, and being able to keep my taxes as low as I can during retirement. The Bible says that we should pay unto Caesar what is Caesar's, but it also says we're supposed to be stewards of our money. And so I think tax planning is one of the things that we can be a good steward about if we sit down and work on it. But too many people procrastinate and don't worry about either one, income planning or tax planning. While we're working, we're doing four things with our money. We're paying taxes, we're paying our bills, we're spending it on, food, clothes, fun, and then we're saving it. In retirement, the only thing we're not doing is we're not saving it because we're still paying bills. We're spending it for the things, necessities of life, and we're paying taxes. Taxes are not going away.
We need to be cognizant not only of that, but of the full implications of every decision we make with the placement of our money, income, growth, and distributions. What are the long-term consequences going to be? And there's really kind of a double and triple whammy effect here, John, that a lot of people are being surprised by. Not only is growth our objective when we invest, but the IRS seems to have realized a long time ago that when our account grows, if it's tax deferred, then they benefit from that growth as well. But you touched on it. Social Security and Medicare costs and premiums are also tied into all of this from a tax planning standpoint.
That's right, Peter. The more you make, the more you're going to pay. And so you can't, and a lot of times you can't defer it because you're doing these required minimum distributions on these large deferred amounts. And so that will put us in a different tax bracket and make us pay more for our Part B Medicare, and also for our drug card, and also for up to 85% of our Social Security is taxable. A lot of people don't realize that their Social Security can be taxed. And based on income, which isn't that much, I think the top tier was $34,000 for a single taxpayer. That's 50% of their Social Security is included in that number, can be taxed. And then it goes up to 85% as we make more. So it's really important that we keep our income down. In life, we've got three buckets. We've got the taxable, the tax deferred, and the tax free. Now, we want as much as we can get into the tax free, but we were taught to put as much as we could in the deferred. And so I have clients who come in and all of their money is in that deferred bucket. They have hardly any cash and they have nothing tax free. We have to restructure this. And we also have to change the thinking of the younger generation as they move forward. And it's better to pay taxes now.
Yeah, absolutely. I think there is a shift in paradigm. And I know that your advice is very specific based on the person, the individual, the situation that you are talking to, addressing, and planning for. But maybe younger folks have a very different perspective and guidance and recommendations of what they should be doing than somebody who is on that doorstep of retirement. But we shouldn't be beating ourselves up or kicking ourselves or believing that it's a mistake if we have been a proactive saver and have built up that sizable tax deferred retirement balance, John. It's just that now is the time to really examine that and do the best things that we possibly can with it. And I know that's a big part of what you do there, is helping people make that transition between buckets where possible, and doing so with the planning and the full implications of that in mind.
Well, we have to do the tax planning as we do that. We have to look at the taxes, how it's going to affect you, let you understand where you're going to be. And if it's before age 65, Roth conversions are a great way to go because we can move that money and it won't affect your Medicare, won't affect your Social Security. After 65, it gets a little bit harder, but we can still do it to some degree. So, Peter, it's not the fact that we've done wrong. People who saved for retirement did the right thing. It was what the government gave us at the time to save in, and the boomers now were taught to defer. And so all these years since the 80s, we've been deferring, thinking we were going to be in a lower tax bracket. And I can tell you through actual experience, we're not going to be in a lower tax bracket.
All right, John, I'm going to put you in the hot seat, rapid fire here. April 18th is this year's filing deadline. What opportunities do we have between now and then to consider?
There's not much that we can do, Peter, but we can still make IRA and better is a Roth IRA contributions, and you can still contribute to your SEP plans. Those are about the only things we can do.
Yeah, but those opportunities are pretty limited. So in reality, we need to look forward.
Well, between now and then, there's not much we can do, Peter. It's we're looking at what we did last year for April 18th. What we need to do is we need to be looking forward for what we're going to file next year in April. So this year is the year that we need during the next 9 months, 10 months, 11 months. We need to be making the transition and doing as much as we can to look at Roth conversions, look at ways that we can get our money tax free. And so there are municipal securities, other things that we can do to buy to keep our costs down, keep our income down, reposition certain assets. If we've got everything that is, some clients have everything it's all taxable. We want to make sure that we can come up with some income, some annuities and other things for them that we can shelter some of that tax exposure. So, it's just a matter of looking at everybody's account, doing the tax planning, doing the income planning, and then giving them the best advice that we can find on how they can move forward. But the main thing is look at Roth conversions. Roth conversions are a great way to go, a great way to move that money into that tax-free bucket and get it out of that deferred bucket.
Well, continuing the hot seat, John, can you think of any crazy tax situations or stories that you have encountered?
Well, I mean, we're looking at tax stories every day where a guy ends up getting $100,000 bonus, and he's retired, but he's still working, or he's not retired, he's not working, but he's on Medicare or Social Security. He has to write the Social Security Administration and ask for a waiver on his IRMA. I mean, those things happen every day. It's amazing to me. People who retire and get paid a lump sum, that creates a huge tax burden for them and can create a higher Medicare Part B premium going into retirement. It's crazy. We had one guy that maxed out his IRMA. He paid the maximum amount he could, I think it was $500 something a month, because of a bonus and the way his company got structured when he sold it as he went into retirement. So we have to think about all these things, Peter. You don't think about that when you're thinking about retiring. You don't think about how it's going to affect you and how much taxes you're going to actually have to pay.
Well, John, a lot of specific and individual situations out there, but the bottom line, again, even you and all of the rest of us, we have to file, we've got to pay taxes. So it's something that we should be thinking about each and every year. And as we do, it's a good time to think a little bit more proactively about it, ladies and gentlemen. That is where you have the most control. That is where you have the most opportunities to look forward into the year and all of the years ahead. And that is the financially focused written retirement income plan with that proactive planning strategy and perspective with taxes in mind included as part of that. John Kuykendall, his team there at GulfCoast Financial Services, they can put that together for you. No cost, no obligation. All you need to do is give them a call, 386-755-9018, 386-755-9018. And John, here's the real important part of the program. Even for existing clients, those that already have plans in place, the laws have now changed. I know that you always do regular reviews and keeping your clients and their plans current and up to date, but especially after something like the passage of the Secure Act back in 2019 and now the passage of the Secure Act 2.0, it's time to review and update those plans once again.
Well, even more so, Peter, because, there are a lot of changes with the company plans, the 401k Roth now, 529 to conversion to Roth, a lot of different things going on that people don't realize, people don't know about. And so it's time now for everybody to come in. But more importantly, Peter, it's time for you to start doing proactive tax planning. We've got the rest of this year to do that for next year. And so we need to start now. We don't need to wait until November and December and try to plan. It's like the person that called me the other day and wanted to contribute to their simple IRA after the end of the year. You can't do that, Yeah. And so you gotta think ahead.
Well, I think that the tax deadline is like the procrastinator's annual holiday. That's when we all wait around till the very last minute to all unite together and actually take care of something. But John, that's not the best way to go about it. Now, we may not want to file too early because sometimes documents get corrected or we get documents a little later and then we don't want to have to refile. But it's not the best approach to procrastinate to the last minute and then file based on last year. This is one area where we have extreme, significant, realizable benefits from being a little bit more proactive in the way that we think about things. So get a jump on that, ladies and gentlemen. Have those conversations. Let the experienced, qualified professionals at GulfCoast Financial Services help you in strategizing and identifying the optimal ways that you can be efficient with your planning, with your taxes, keep more of your money. Give them a call, 386-755-9018, 386-755-9018, or visit online, GulfCoastFinancial.net. John, always a pleasure.
Thank you, Peter. Great to be here, and let's hope we can get some tax planning in.
Absolutely. A fun conversation about taxes today, John.
Nothing fun, Peter. Nothing fun.
Talk to you soon.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.